Welcome to Beyond the Numbers. I'm Bev Wakefield, and this is the podcast where we take the stress out of business finance and break down the numbers in a way that actually makes sense. Have you ever sat in a meeting nodding along like you know exactly what EBITDA or accruals means, but inside you're thinking, what the heck are they actually on about? You're not alone. Accounting jargon can make even the most confident business owner feel like they're back in maths class, staring at the board with no idea what's going on. In today's episode, we're decoding the most misunderstood financial terms that frustrate business owners every day, whether you run a service-based business, a product manufacturer, or an e-commerce store. We'll cut through the fluff so you can stop glazing over in finance meetings, make better decisions, and actually understand the story your numbers are trying to tell you. Because when you understand the language of business, you don't want to put your head in the sand and realise that actually they can tell a story after all. Most business owners don't go into business because they love numbers. You started your business because you're great at what you do, whether that's coaching, making things, selling products, but delivering real value. But somewhere along the line, you're expected to become fluent in accounting jargon, tax rules, and financial reports. And let's be honest, profit doesn't always mean cash. EBITDA sounds made up, and VAT sounds like witchcraft. The pain shows up as cash in the bank, but still not enough to pay bills. Huge profits on the P&L, but you're not paying yourself properly. Confusion over taxes when you've made no money, and there's panic when HMRC letters arrive. And you've made pricing mistakes that make you feel like you're working for free. These aren't just admin issues, they are confidence killers, growth blockers, and stress creators. It's time to help you understand it. Let me tell you about Sarah. She runs a small marketing agency. Her P&L said she made £60,000 in profit and she was buzzing. So she paid herself a bit extra, bought some new kit and didn't think much more of it. But then VAT bill landed, corporation tax followed, and her accountant said she owed the company £10,000 as a director's loan. That buzz turned into a full-blown panic. Because she didn't understand that profit is not cash, that VAT is not your money. Taking money out without declaring it properly creates a loan and a tax charge, and it wasn't her fault. No one had explained the rules, but it's nearly broke her confidence and her cash flow. So let's break down the common culprits. The first is EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In real terms, it's your profit before big costs like loan repayments and the wear and tear of your assets. It's good for comparing businesses, but it's not the same as cash or total profit. It's good to see where EBITDA shows up to in the ladder of other terms. So if we think about revenue, gross profit, operating profit, EBITDA, and then net profit. The next Accountanese is accruals versus cash basis. Cash basis is a record when money hits the account. So if you're a sole trader, you can record your income on a cash basis. However, as a limited company, everything is reported on an accruals basis. The accruals basis records when it's earned or spent, even if it's not paid. So the trap here is you might think you're profitable, but if clients haven't paid, you're not cash rich. You might deliver work in March, but not invoice until April. On an accruals basis, that income belongs in March. You may even spend more money on things like stock, hoping this will reduce your profits, perhaps as a tax-saving mechanism. However, this stock is matched to the period when you sell it. The beauty of accruals basis is that it helps businesses look at the P&L of when work is being completed, not when it's invoiced, but it can cause confusion around cash. Next is cash flow versus profit. This is a huge one for businesses. We delved into this further in episode 1, but as a reminder, profit is a nice number on paper, but cash is actually in the bank. The difference, timing. You can make 10k profit and still owe 15k. That's how profitable businesses go bust. I'll put a link so you can go back to this one as it's a whole separate podcast. Up next is VAT. VAT is value added tax. And here's the most important thing you need to know. It's not your money. You're just holding on to it on behalf of HMRC like an unpaid tax collector. If your sales hit 90,000 in a rolling 12-month period, you must register for VAT. or even if you expect turnover to go over 90,000 in the next 30 days. Once you're registered, you have to start charging 20% extra on most of your goods and services. So if you charge £1,000 for a service, that's now £1,200. 200's owed to HMRC. On the flip side, you can claim back the VAT on your business, software, laptops, and possibly even plant. Now, if your VATable turnover is under 150,000, there's a flat rate scheme that might save you time and sometimes money. So instead of tracking every single in and out, you pay a fixed percentage of your turnover. That percentage depends on your industry. For example, IT consultants are at 14.5%, hairdressers at 13%, CAFs at 12.5%, and there's even a first year 1% discount. You still charge 20% on your invoices, but you pay over less. So what's the catch? You can't claim VAT on most expenses unless the invoice is over £2,000 net. So it's great for service-based businesses with few overheads. But when do you not charge VAT? If you're under the threshold, you don't have to register, although you can register voluntarily. If you're selling to non-UK customers, especially outside the UK, VAT may not apply. Exports and certain services are often zero rated or outside the scope. Some goods and services have reduced rates, 5% or zero rated. Think children's clothes, books, and some food. Others are exempt, like insurance, some training, and health services. Confused? You're not alone. This stuff can get murky fast. It's best to speak to your accountant about your position. Right, let's talk about the one thing that sneaks up on far too many business owners, corporation tax. You've made a profit, amazing, but don't get too comfy just yet, because HMRC would like a slice, thank you very much. Corporation tax is the tax your limited company pays on its taxable profits. Now here's the catch. Taxable profit isn't always the same as the number at the bottom of your profit and loss account. You can have all sorts of adjustments, things like depreciation, entertaining clients, which HMRC loves to say no to, and capital allowances. But corporation tax range from 19% to 25% depending on your profits. Now, if your company earns over 250,000, you're taxed at 25%. If you're under 50,000, it's 19%. But between those, it's tapered with something called marginal relief, a sliding scale. Now, something to watch out on. If you have more than one company under your control, or it's connected through shareholdings or family, these thresholds are divided. So instead of having one business having a 50k at 19% rate, you might get 25,000 at that 19% if you've got two associated companies. It's one of those technical tweaks that can make a big difference and a great reason to get proper advice before setting up another company. So as a tip, I suggest setting aside 23% of your year-end forecasted profits for corporation tax. Then review with your accountant before year-end for tax planning opportunities. Don't leave it until it's too late. Ever looked at your accountant when they've said you have an overdrawn loan account and you owe 10k back to the business and wondered how this happened? Let's first understand what a director's loan is. A director's loan is any money that a director takes out of the company that isn't a salary, a dividend, or a repayment of money the director previously lent the business. In other words, it's you taking cash out of the company. It also works the other way. If you put personal money into the company, that's also recorded as a director's loan, but the company now owes you instead. If your director's loan account is overdrawn by more than £10,000, you have to start paying interest on it, and it's taxed as a benefit in kind. If you don't repay the overdrawn amount within 9 months of the year end, the company must also pay a temporary 33.75% corporation tax charge on that balance, and that's called Section 455. You can claim this back, but only when you repay the loan. So it's a cash flow hit, and HMRC holds on to the money in the meantime. A lot of the time this happens because you haven't planned how much you're going to take out of the business and how and when you're going to declare dividends. Make sure you talk to your accountant and do a forecast of your income. Also keep an eye on your numbers. Remember, you can't rely on dividends unless the company is making profits. And the last one I want to touch on is depreciation and making it simple. Depreciation is just the accountant's way of recognizing that some things wear out or lose value over time, like your laptop, your van, or your office furniture. Say you buy a van for 20,000, it's not gone in year one, it gives value over several years. So instead of taking the whole 20,000 as a cost in year one, we spread it, say £4,000 per year for 5 years. That's £4,000 per year in your depreciation. But why does this matter? It affects your profit on the P&L, but it doesn't touch your cash flow because you paid for it up front. This is why you see profit after depreciation being lower than the cash in the bank. And also why things like EBITDA, which ignores depreciation, exist to show core performance before those kind of accounting entries. So now I want to look at the KPIs that matter. You don't need an MBA, you just need this dashboard. Let's break them down into various different themes. The first one's all about financial health. So the first one's your gross profit margin. This is looking at your sales minus the direct costs of making or delivering your product or service. And this tells you how profitable your offer is at the core. So the way to work out the margin is to take your gross profit over your sales and times this by 100%. So in this instance, our gross profit margin is 60%. When you look at your margin, think of it as you're keeping 60p out of every pound you sell to go towards your fixed costs. Now, margin and markup get confused. Markup is the cost of sales you pay for and how much you mark them up. So on this £60,000 profit, £40,000 is your cost of sales. This is 150% markup. It's a really important one to get right, because if you think the markup but price using margin, you could undercharge without realising. So if you want a 50% margin, you need to mark up by 100%. If you just add 50% onto your cost, your margin is only 33%. Now, net profit is what's left over after everything has been paid. Not just your cost of sales, not just your team, but also rent, software, your accountants, subscriptions, marketing spend, loan interest. It's the final figure on your profit and loss account, the one at the very bottom, often called the bottom line for a reason. So let's say the business turns over the 100,000, your cost of sales are 40,000. That gives you this gross profit of 60. Now, thinking about all your other overheads, admin, salaries, rent, software, etc. Let's say these total 45,000. Now you're down to £15,000 net profit. Your net profit margin is your £15,000 over your 100,000 sales, times it by 100% to get to 15%. So a healthy net margin for service-based business is 15 to 30%, product-based 5 to 15%, retail or e-commerce 2 to 10%, and agencies and consultants, you're looking at 20% plus. Next up is the break-even point. How much do you need to sell to cover all your fixed costs? Knowing this means you're not guessing if you can afford that hire or that new office. Your break-even point is the amount of sales you need to cover all your costs. So you're neither making a profit nor a loss. In plain English, it's the minimum you need to sell to keep the lights on. There are a few ways to calculate it, but the basic one is to take your fixed costs over your gross profit margin, and this will create your break-even sales. So let's use an example. If £40,000 of fixed costs, which is your rent, salaries and software, and actually you make a 60% profit margin, or if you can work out how much your product sells for, so say it sells for £100 and it costs you £40 to make it, then we can calculate this 40,000 over that 60. It means we need break-even sales of £66,667 before you make a single penny of net profit. Now, the next kind of section is efficiency and productivity. A good one is debtor days. This is how long it takes clients to pay. The higher this is, the tighter your cash flow. So take your trade debtors, divide these by your annual sales, times it by 365, and this will calculate how many days on average it takes to get paid. So if your debtor days are 45, it means your clients are paying you 45 days after invoice on average. High debtor days, cash is stuck. Great sales don't mean much if your money's always in transit. So if we take the 12,500 of trade debtor days over your annual sales of 100,000 by the 365, this gives you just over 45 days. Now, another one is trade creditors. It's a really good one to kind of take account of how long it's taking you to pay people you owe. If your creditor days are 60 days, it means you're taking 60 days to pay your suppliers. Now, whilst longer creditor days can be better for your cash flow, it can obviously cause upset suppliers. Paying too slowly can hurt relationships or credit terms. So it's a balance between holding cash and being reliable. What you do to do this calculation is you take your trade creditors, divide these by your purchases, and times it by 365. A great way to get in control of your creditors is to utilise something like Xero and Modular to make those payments easier. Now, the next one up is stock turnover. So this is for product-based businesses. So it's how quickly you turn your stock into sales. If you've got a low turnover, you've got money sitting on the shelves. So what we're going to do, we'll run through this calculation. You take the cost of goods sold, so the cost of purchasing that stock, and then you divide this by the average stock that you're holding during the year. So let's take 120,000 and assume our average stock is 30,000. This means it's 4 times. This means we're turning over our stock 4 times a year. Next one up to utilisation rate. So this is how much time is spent on chargeable work versus total time. So this is a great one for service-based businesses. So you take a look at the amount of chargeable hours your team are doing in comparison to the total available hours and times this by 100. If you have 100 hours in a month and only 60 are chargeable, you have a utilisation rate of 60%. Now, low utilisation means inefficiency or overstaffing. A high utilisation, strong productivity, but watch out for burnout. Now, this is great for agencies, consultants, accountants, and other service-based businesses. Now, this next section is all about growth and strategy. The first one I want to look at is customer lifetime value. This is how much a typical customer is worth to you over time. So the formula, simplified, is your average monthly fee per customer, and you times this by the average customer lifespan in months. So let's take an example. Say your average monthly fee is £500 per client, and your clients stay with you for 36 months. This means that a client is worth £18,000 to you over their lifetime. The next one up to look at is the customer acquisition cost, or the CAC. This is where we start looking at the formula of looking at your total marketing and sales costs and divide this by the new customers gained. This tells you how much it costs you to win a new client. So for example, if we spend £10,000 on marketing in a quarter and we gain 20 new clients, this means that our CAC is £500 per customer. But why does this matter? The key thing here is considering, are you spending more to win clients than they're worth? Is your sales process efficient? The CAC should always be considered alongside your customer lifetime value, so you know it's worth the investment. So based on these numbers here, if your customer lifetime value is £18,000 and it's only taken you £500 to acquire a new client, this means we're getting a ratio of 36:1. Now actually a really good ratio is 3:1 or 5:1 is a perfect situation. 36:1 probably means that you're under investing in your marketing and leaving revenue on the table. The big idea, the more profit you make per client compared to what it costs to win them, and the more scalable and stable your business is. But if it's costing you more to get clients than they're worth, you're not building a business, you're buying yourself a job. Next one up is revenue per employee. This is a good benchmark for team efficiency and scaling and allows you to compare your organisation's performance to others in the industry. So what we do here in the formula is we take our total income, our total revenue, and divide this by the number of employees or full-time equivalents. This shows you how efficient your team generates income. So for example, if a business turns over £500,000 with 5 team members, that means our revenue per employee is £100,000. Why does this matter? It helps you benchmark against others in your industry. It helps you to spot overstaffing or underperformance and track it as you scale, because growing revenue faster than headcount is a good sign. The next one up is churn rate. This is looking at the percentage of clients or customers who stop buying from you in a set period, usually monthly, or you could consider this annually. So you started the month with, say, 100 clients and you lost 5. This means your churn rate is 5%. So why does it matter? High churn is unhappy customers, poor onboarding, or lack of value, whereas a long churn shows us that we've got strong loyalty and predictable income. It's cheaper to retain a client than to win a new one. Even a small increase in churn can quietly destroy a growing business. And the last section is some bonus terms we love at Vibrant. The first one up is revenue by service line or product category. So what's actually bringing in the bacon? Stop guessing and use your data for decision making. Also start being able to look at profitability by client or project, or even service line. Great if you do custom work. Some clients might be lovely but unprofitable, and it's important to spot this early. And then the next one is budget versus actual. Did what you thought would happen actually happen? And if not, why? And what was the driving factor for that? What do you need to do more of or to tweak? So every KPI tells a story. Together, they can help you to spot problems early, to highlight opportunities, or help you price right, spend wisely, and grow sustainably. Without them, you're driving blind, and that's not how confident businesses are built. Understanding these terms isn't about becoming an accountant, it's about knowing where your money's really going, spotting red flags before they become crises, pricing properly, planning ahead, and feeling confident when you're talking to your accountant or the bank. When you understand your numbers, you lead with clarity and confidence. You stop being reactive and start becoming strategic. Building a business that works for you. In the next episode, we'll dig into the owner trap, why so many founders end up overworked, underpaid, and stuck doing everything, and how to build a business that doesn't rely solely on you to survive. We'll unpack the key financial shifts and mindset changes that move you from bottleneck to business owner so you can grow sustainably and get your time back.